The undisputed laws of the financial markets.
I was looking to get everyone's opinion on the financial markets. I'm defining the financial markets as the stock, options, and commodities markets. I'm looking for 100% laws, not ambiguities or feel-good mantras that aren't 100% accurate. For example, the law of gravity works 100% of the time.
If you drop a marble from your hand, it will, 100% of the time, fall to the floor. Another example is not a law but a guideline. It isn't a law
and just means don't get too greedy. Relates to options markets. What other laws can you think of? Or, what might be a law? A stock will never rise to infinity.
A stock never goes straight up. Remember, a law is indisputable.
For every dollar that you make, someone has lost $1. The same person had every intention of profiting, not losing money.
So true. Not sure if this would count as a law, but always do your due diligence. The market will humble anyone.
Any stock can go lower until it reaches zero. There's no such thing as a stock that has reached its bottom unless it is at zero.
Is this really true? I'm by no means a financial guy, but I'm fairly certain the markets are not zero-sum.
But those 4 you listed sound right on to me. I am interested in this as well. Depending on what you are trading. Not every kind of trading is zero-sum.
Prices fluctuate. There is no right price, only what the market agrees. For now, markets can stay rational longer than you can stay solvent. Anything Number 5 happen. The market is always right.
Possible. Number 6 It doesn't matter how valuable you perceive something to be. It's only worth what someone else is willing to pay for it.
Let's liken trading to chess. You take a pawn, your opponent loses a pawn. -1 + 1 = 0. If I'm wrong, please enlighten me. It would be nice to have free money.
Consider yourself enlightened. You can feel free to Google it as well if you feel I am wrong. But I read this a while back and I believe I am correct.
Here's another. Past performance is not a guarantee of future results. To find the undisputed laws, just read the fine print from financial services ads. Their lawyers spell them out for you.
Thanks for the link, Carrie. I don't have much spare time, so only had a cursory look, but it immediately looked to me as though the writer is describing the process for a small set of trades and completely ignoring the big picture that even though someone may lose a trade and may later make a larger win on the same stock or whatever, that in the long term the money to pay for these profits has to come from somewhere. I'm not an expert and may well have this wrong, but I don't want to hijack this thread, so we'll leave it at that.
That's funny. I was just writing about how the value equation is an economic law. Here's what I think are some laws. Law 1. Risk increases as more variables are unaccounted for, and risk decreases as more variables are accounted for. So in other words, I think that the more risk equals more reward is total BS. Law 2. As interest rates increase, corporate earnings tend to decrease. Law 3, supply and demand is a law because it's derived from logic and mathematics graphs. Law 4, nobody knows where the market is going because psychology is very difficult to measure, but the more you can account for, the higher chances you have of getting it right. Law 5, the long-term movement of the stock market is up.
All fiat currencies eventually fail. 2 commodities will never go to zero. 3 precious metals are the assessors of the markets. Just in case anyone else wants info on this, here's another source that's not a person. You can't liken trading to a game. They don't follow the same rules.
So the risk or reward ratio is for assuming more risk. Investors want a more reward potential. It's not really risk equals reward. Most are looking for alpha, generating more reward for a given level of risk. Any fool can take on more risk willingly, kind of like buying wine. You can pay through the nose for a nice bottle, but the true winos love to find a great bottle for the price. As far as zero-sum game, some say no and differentiate the market from gambling, which is zero-sum. They are not directly comparable, since in the markets there are unrealized gains or losses. However, if the market was immediate settlement, you would realize gains or losses. The confusing factor is if stock XYZ has 50 million share float and one share trade boosts the price by $1, you just created $50 million in added market cap. However, if all those shareholders went to sell to capture the $1 gain, well, You know what will
Something
happen. Derived from logic and mathematics are an opinion and not a fact, therefore it cannot be a law. Also the tend to in the law too that you proposed makes it automatically not a law because it can also not.
Newton's 3 laws of motion are derived from logic. And mathematics is a law because you can't disagree with 2 plus 2 equals 4.
Mathematics is a law. I agree. Different forms of math can contradict each other and still be a law, such as counting on base.
The laws of motion may be derived from logic, but they didn't become laws until they are proven. Just because something seems logical doesn't make it a law.
It was logical that the Earth was flat until it was proven it was not. Putting both together and using that to form a conclusion is a hypothesis. Not until it's proven does it become a law. This is coming from a high school dropout. Still, I think I am right. Please, if I am wrong, let me know.
The only real market data that is relevant to anything is what the market you are looking at is doing at the present moment right now. Past performance does not guarantee future returns.
Markets can remain irrational longer than you can remain
The
solvent.
markets are a negative-sum game. For every transaction there is a winner and a loser, and the brokers and exchanges
In a
take
bull
a
market,
cut.
the small cap stocks should go the fastest because institutional investors are always get killed by the speculators. Remember the Nifty 50?
The only market which is zero-sum is the options market. Futures may be as well, but I haven't ventured into those yet, so I'm relatively uncertain. Suffice it to say that cash-settled markets are probably zero-sum or negative-sum if you consider broker costs.
This is not to say that you are guaranteed, nor even statistically likely, to lose money in them. The stock market and commodity markets are not zero-sum, and there is a reason.
Some people have a lost decade in American stocks, as the S&P 500 has not progressed past its previous high in several years. Does this mean that no one has gained anything from the time they spent holding shares of companies in 10 years?
Of course, one could argue that the traders profited, but they didn't hold onto their shares for that whole time. What about the investors? Consider a random company, such as First Energy, an electric utility.
In October of 2001, its stock was at about $36 or share. In March of 2011, its stock was again around $36
Of
or
course,
share.
looking at the chart, shareholders may have been upset they didn't sell it for $80 or share, but did they literally gain nothing for being a loyal shareholder?
Of course not. During that time, First Energy paid $17.67 in dividends, which would be a 49% gain on the $36 or share. If reinvested, that number would be even higher.
Of course, 49% over 10 years isn't a great return, but is it zero? The non-zero aspect of the stock market comes from the fact that not only does money come in from people buying shares back and forth, but also from legitimate business operations and profits, in the form of dividends.
These increase the total pool every year, and are technically the reason people invest in stocks in the first place, to get some share on their profits. Charts and indicators don't move price. Price moves the charts and indicators.
In a liquid market, the price at any moment is determined by the last two people who decided they want to make a trade right now. The longer something goes away from the average, the more likely it is to reverse. The actions taken by the most people at the same time are self-defeating and money losing. Something that doesn't produce cash for the owner is only worth what the next buyer will pay for it. Trading between owners in a market will decrease the total profits that all owners collectively make in that market by the amount of the fees.
Only cash flows directly to the owners, or acquiring or selling outside of that market, can increase the total profit of all owners.
Not exactly rules, but Mark Cuban wrote some harsh truths about the stock market the other day in his blog. My favorite part is where he distills what fundamentals are all about. I found this article to be helpful in describing markets. I trade forex and see attractors all the time. And self-similarity is changing time frames. The charts look very similar yet different because of different attractors. Don't know the dynamics behind stocks or options as I don't trade them. I found this to be very helpful in discovering predictability in sometimes unpredictable market. Elliott wave theory is a very simplified version of chaos theory. I found Elliott wave to be worthless in forex. Just like most oscillators. Maybe it works better with stocks because of the nature of stocks, and that is where it came from. 1. Not all trading is zero-sum, but futures markets are. 2. Markets fall faster than they climb. 3. More traders fail than succeed. Some laws that have stood the test of time. 1. Insiders are more likely to make money in the markets than outsiders. You can become an insider in a market by knowing people on the inside or by systematically studying a market or industry. I did the last with the IT industry and it paid me well. 2. Risk is a result of not knowing what you are doing.
Therefore, never invest in an industry you do not understand. Also, and Buffett confirms this, there is no need for diversification if you know what you're doing.
The price
3.
of commodities is roughly constant through the decades and centuries. For instance, the price of houses is roughly constant when expressed in gold. 4. Bubbles burst when your taxi driver, shoe shiner and grocery cashier are going into the market.
Volume tells a story.
1. You can't go broke taking profit. 2. You can't go broke breaking even. 3. Only a big loss can hurt you.
Don't be afraid to take what the market gives you.
I would say, the only thing you control in the market is how much you can lose. Every market participant has an inherent advantage. The only money you make in the market is the money you take out of the market. Any method that makes money fast can lose money fast. Anything known about the future can be exploited for profit. Every dollar ever traded was traded as part of a larger system. If you extract your initial capital from the market, you can never lose money. Trading what works changes over time.